All right. Hello, everyone. Thank you for tuning in to the magnificent technical analysis of the Magnificent Seven. And I think we're on number five now. Yeah, this is Facebook. Notice I call it Facebook and not Meta because I'm old and stuck in my ways. But one of the things I wanted to point out about charting. Oh, by the way, I'm Mark. I'm the stock market jobber. Hopefully, you'll like us and sign on or whatever you can do because we got a really cool community here and bunch of our people are doing really well. But anyway, one of the things to understand about when you look at a chart is that you're looking at psychology, right? And if you read the intro, it's like candlestick charts were first developed 500 or 600 years ago, and the same patterns still apply today. We could look at charts of the S&P going back to the 1870s and the Dow going back to when it started in 1898. You see the same patterns that you see now. What was support becomes resistance. Look at this. Support here becomes resistance. Why? Well, this is because of buyer's remorse. There's people who bought back here. And then when the price finally went lower, a lot of them say, man, I made a mistake. If it gets back to my price, I'm out at break even. So remorseful buyers placing sell orders at the level that was support can convert support into resistance. This is a graphical illustration of buyer's remorse. And now, just like back then, the technology has changed, the companies have changed, the people have changed. But what hasn't changed is human psychology and emotions. And this is what we see at a chart if it's looked at correctly. So let's see what we can see here. Well, we talked about support turning into resistance. Here's a candlestick pattern. I don't know what you would call this thing. I guess you'd probably call it a hammer because it looks like a hammer. Looks like the sledgehammer that is in my backyard, which I always tell myself I'm going to work out with, but I don't. But I'm going to tomorrow. All right. Anyway, let's think about what this shows. All right. A blue candle is a day where the closing price is higher than the opening price. All right. The wick goes up to the highest price on the day and the lowest price on the day. So the body of the candle, I guess, this vertical rectangle shows the opening price and the closing price. On a red day, it's the opposite. The closing price is lower than the opening price. Now, if you look at the wicks, and this is why we call them candlesticks, they show what was the high trade on the day and what was the low trade on the day. So now, with all that knowledge in your mind, let's think about what this hammer pattern shows. And who the hell cares what it's called? Hammer, sickle, whatever, man. Back in my training days, we used to call when people had comments about, whatever patterns, we'd be like, oh, it's the old triple Lindy pattern, from the Ronnie Dangerfield movie. But anyway, this stock opened here on this particular day. All right. So the opening price was 465.80. The low was 454. It got all the way down to here. But what happened? By the close, the buyers stepped in, overpowered the sellers, and pushed it back up above the opening price, and it closed higher. So forget that this is a hammer pattern or whatever you want to call it. Think about it. What does it show about supply and demand? And it shows that there's a day where it looked like the sellers were going to win the day, but by the close, the buyers pushed it all the way back. And that showed us that the trend was turning. Sometimes trends take kind of an extended time period to change. But sometimes they change in one day, and that's an example right here, the old hammer pattern. Let's see, what else do we see here? Now, I don't know what this is called. It's probably called something. But as a trader, it's like no one pays you to name patterns. What tells me is, wow, the buyers are getting really aggressive here. So we had this big sell-off. I don't know. I don't remember why. It's probably new, probably earnings. But the stock closed here. The next day it opened here. And what happened? It closed all the way up here. This shows that the buyers were coming in and aggressively buying it. They were like, oh, this sell-off is overdone. A little bit of consolidation, and that set the stage for a move higher. So the important thing to remember is it's not about just like being this is this pattern or this is that pattern. It's about understanding what these things illustrate. For example, look at this here, right before this big sell-off. Really aggressive selling here, really aggressive selling here, really aggressive selling here, really aggressive selling here. Well, maybe not so much here. And the buyback days, the rebounds are really kind of weak. So this just shows that the sellers were firmly in control of this market. Who the hell cares what the pattern is, if it even is a pattern? That's not what I want to teach you. What I want to teach you is, what do the graphical patterns illustrate? All right. All right, so let's take a look at Facebook. I don't know. Let's look at the one-day chart. What's really cool about technical analysis is a lot of times you can see these same patterns occurring in different time frames, and that's because regardless of the trader's time horizon or style, whether they're long-term, short-term, they experience the same emotions. Here we have an example of where what was support converts into resistance. And look at that. You don't need to be a chart guru to see that this is just a chart of today, that this level was resistance all day. Why would a support level convert into resistance? Well, buyer's remorse. People bought, goes higher. They're like, oh, I made a great trade, but then it goes lower. They say, I made a mistake. I'm going to get out of this thing if I can at break even. So when it gets back up to their price, remorseful buyers placing sell orders can turn support into resistance. All right. Why would resistance stay intact? Same thing, but manifested on a chart in a different way. People buy here and the price goes down and they're like, oh, if it gets back to my price level, I'm going to get out at break even. So as we can see on a chart, if we look at it the right way, what we're looking at is traders' emotions. Forget Facebook stock. Just think about the people who are trading it. Here we see the same dynamic. See how support here became resistance here? Well, what happened here? Support here became resistance here. And then we have the example where resistance becomes support. Certain price levels are more important than others. That's just how it is in the markets. So resistance becomes support because of seller's remorse. People sell and then they thought they did the right thing when the price drops, but then it goes higher. A lot of them say, I made a mistake. If I can buy this back at the same price I sold at, I'm going to. So we see these same things. Now, in terms of candlestick patterns, this here, I think, would be the old bullish engulfing pattern, right? And forget the name. I know it's kind of hard to see, but technically this would be a bullish engulfing pattern because we got this downtrend going on, and it looked like at this particular time, and remember, we're looking at minutes now. We could be looking at days. We could be looking at weeks. The same principle of supply. I call that the fractal nature of charting. But it looked like it was going to be another down time period. But by the close, the bulls push it all the way back. So this is an example where the trend changes really quickly. Oh, look at that. There we have our old descending triangle. These are pretty reliable patterns. Just think about what this shows, right? The buyers have made a stand down around here. The buyers are like, you know what? I'm just going to chill out. I'm going to stay here. If the sellers come to me, great. If not, and I miss, whatever, I don't care. But as time is going by, the sellers are getting more aggressive. They're willing to accept lower prices. So you got this combination of kind of complacent buyers and aggressive sellers. And what does that mean? Well, it sets the stage for a move lower. There you have your descending triangle pattern. All right, what else we got here before I get going? Here's your quick reversal here. This is probably some kind of a pattern, but we're going down. I mean, it's probably has a name. I don't know what it is, but again, it's not important to know what the name is. If you were trading this, you saw this big downtrend, and then all of a sudden the trend lower stops, and we get this big move out of it. We gap up, and we get this big move. This shows that buyers are coming into the market. This was a signal that the trend was changing. I don't know what this is called. It's probably got a technical analysis. A candlestick name. I would be willing to bet that if you went back and you saw charts of what the Romans traded and what the Phoenicians traded, you would see the same patterns, because even though that was like 2,000 years ago, they had the same emotions that we do now. And if you're looking at a chart, that's what you should be looking at. Psychology, emotions, and supply and demand. People make it way more complicated than it should be. All right, everybody, please remember to sign up and subscribe, and I'll see you soon. Thanks.